joining us from the US. Welcome to the QuickFee FY24 full year results webinar. On our call today, we have Simon Yendall, CFO, and Jennifer Warrower, President North America, to run through the presentation. And we also have Dale Smorgan, Chair of QuickFee, on the call to answer any questions after the presentation. And my name is Katie McKenzie, Investor Relations for QuickFee. After Jennifer and Simon conclude the presentation, we'll open it up for Q&A. We won't be using the hand raising function, so if you have any questions, please type them into the Q&A tab at the top of the screen. If we don't have time to get through all the questions today, then we'll reach out to you directly following the webinar. And now I'd like to hand over to Jennifer.
Thank you, Katie, and good morning, everyone, and good evening to those of you joining from the US. We're very glad that you could join us today as we share an overview of the progress we've made in the QuickFee business in both the US and Australian markets in our 2024 fiscal year. Everything we're going to share with you today is based on a relatively simple business focus for QuickFee. We help professional service firms automate and accelerate accounts receivable while at the same time supporting them as they grow their firms. Over the next 40 minutes, we're going to share with you an update on the market dynamics in the US, an overview of QuickFee's operational and financial progress over the course of the last year. In FY25, we're focused on delivering the outcomes that the business, the board, and you, our investors, know are possible. And we'll also recap our FY25 strategy today. Let's dive in. While we're confident we have the right strategy to support our business ambitions, the proof the strategy is working is all in the results. And in FY24, we continue to deliver strong results, underpinned by great people and a laser focus on relentless execution. As you can see on the slide, in FY24, group revenue was up 37%, and our profitability improved, which was highlighted in Q4 as we were EBITDA positive. Additionally, our transaction volume set a new record in FY24, with US Pay Now TTV being 1.4 billion, and group lending volume hitting 100 million Australian for the first time. We're issuing earnings guidance for the FY25 year, expecting FY25 to be EBITDA positive in the range of 1.5 to 2.5 million, weighted to the second half. And we'll get into how we plan to deliver that later in our presentation. Overall, I'm very pleased with the progress we've made and the results that we delivered in FY24, but I'm still acutely aware that this is just the tip of the iceberg, and there's much more to be done and significant opportunity ahead of us. To click down another layer on the highlights I just shared, group revenue was up 37% on PCP to 20.3 million Australian, driven by increased total transaction volumes and continued margin expansion. Australian revenue up 49% on PCP to 9.1 million Australian. US revenue up 29% on PCP to 11.2 million Australian. As previously called out, we've improved our profitability, delivering group EBITDA of negative 3.2 million Australian in FY24, and we were EBITDA positive in Q4 FY24. We have a stable cost base with operating expenses down 1% on PCP to 15.8 million Australian. And NPAT improved 3.4 million from negative 8.1 to negative 4.7. Along with being EBITDA positive in Q4, our overall EBITDA improved significantly in H2 FY24 to negative 0.5 million, continuing the trajectory of improved profitability. Additionally, our operating expenses were 7.4 million in H2 FY24, down 1 million or 12% on H1 FY24. Primarily due to a decrease in general and administrative and product development expenses. We were being diligent with our spend, and that is making a noticeable impact. We've reported a very encouraging track record of revenue growth half on half for the last 3 years, as you can see here, with EBITDA showing corresponding improvements, which gives us great confidence in our ability to deliver a positive FY25 EBITDA, as mentioned. Now, there are many market dynamics that are shifting and evolving in the US. So before I get into a snapshot of the US business, I wanted to take a little bit of a step back and level set on where we're at in the US market, and particularly the accounting segment. On the accounting profession side, increasing inflation is putting pressure on improving cost management, also driving firms to seek more efficient, automated ways of working. The merger and acquisition landscape in the US is extremely active, and firms are prioritizing accounts receivable reduction to improve valuation. Additionally, accounts receivable management remains a top priority as firms look to better manage their own cash flow. Through the pandemic years, many firms had more business than they could manage. Now, these same firms are now experiencing slower growth and are putting sales marketing strategies in place to attract new customers and are looking for ways to gain competitive advantages. Finally, there's a talent shortage in the accounting profession, and this continues to drive increased demand for automation capabilities across all firm functions. Now let's take a look at the small and medium business side. Uncertainty in the economy has increased, which is causing individuals and businesses to hold on to cash as long as possible. Access to capital through traditional lending has been a challenge for SMBs, with only 25% getting their needs met. And finally, there's more competition for dollars in business than ever before. And couple that with inflationary pressure and increasing operational costs, and businesses are looking for creative ways to make their dollars go further and also hold on to their cash as long as possible. Why is all of this market information so important to QuickFee? Well, let's take a look on the next slide. When we look across our customer base as to why they work with QuickFee, or when we win a new customer, it typically boils down to one of four reasons, and sometimes it's a combination of these reasons. First, they want to reduce accounts receivable. AR is typically one of the highest line items on a firm's balance sheet, and we help turn AR into cash. Second, they want to grow their business. There are many priorities competing for cash, and we can help find more of it for firms and their clients. Third, they want to automate their processes. We increase efficiency while helping improve the client and employee experience. And finally, they want to save on fees. Firms can save thousands and sometimes even hundreds of thousands of dollars on credit card merchant fees simply by passing on credit card surcharges to their customers. Now let's take a look at our solutions. QuickFee's payment platform allows a firm's clients to pay their invoice by ACH or card, which we refer to as Pay Now, and you can think of this essentially as traditional digital payments. We also offer a lending option that's proprietary to QuickFee, QuickFee Finance. This pay over time option allows clients to pay monthly payments over 3, 6, 9, or 12 months, while the firm gets paid in full at no cost to the firm. Finally, our Connect product is a significant growth enabler in the US market. Our existing customers have a combined annual revenue of $1 billion. Right now, only $1.4 billion of that annual revenue is processed through QuickFee. The remaining $8.6 billion is primarily being received by check. This is where Connect comes in. Connect provides integration into leading practice management solutions, helping turn a manual, primarily paper-based invoicing process into an automated digital process by sending out the invoices generated within the practice management solution via email. Those invoices have a payment link on them, which sends the customers directly to the QuickFee payment page. We now have 4 Connect integrations, being CCH Pro System FX, CCH Access, Iris Practice Engine, and Thomson Reuters Practice CS. Now, of course, we have competitors that we run up against, but there are some very specific ways that we differ from our competition. QuickFee's designed specifically for professional service firms. We have no invoice maximum for QuickFee Finance. We have no hard credit checks for clients of firms, and this is important because someone doesn't want a black mark on their credit score simply because they paid their invoice over time. We integrate with the leading practice management solutions, and we have pricing that works for all sizes of firms. We are the best solution that meets the needs of the largest segment of the accounting market, and we have a very competitive subscription pricing model. Now, I shared with you why firms work with QuickFee, and now I'd like to drill into how working with QuickFee meets our customers' needs. Well, it's great for us to tell you what we do. It's even more valuable for you to get a sense of the impact that QuickFee has on our customers. So I wanted to share with you some customer testimonials. First, as we look at reducing accounts receivable, based on our data, firms that are not focused on improving their engagement to cash workflow, on average, have 16% of their annual revenue sitting in accounts receivable and take an average of 60 days to get paid. QuickFee Pay Now and Pay Over Time solutions help reduce accounts receivable and help firms get paid faster. Not only does our data show this, but here's a quote from one of our customers, Steve Grissom, on how his firm's AR has been dramatically reduced by using QuickFee. Second, as I shared earlier, through the pandemic years, many firms had more business than they could manage. These same firms are now experiencing slower growth and are putting sales and marketing strategies in place, and they're looking to win new customers. And of course, they want a competitive advantage as they're doing so. Now, while firms are looking for new clients, 67% of SMBs in the US cited finances as their major concern. So, on one hand, firms want new clients, and their prospective new clients are concerned about how they're going to pay for those services. Jamie Franco from Select GCR shared that 25% of their prospective customers inquire about a payment plan. And this is the consistent feedback that we receive from our firms. Not only can QuickFee Finance help firms land new customers, but it really can be a true competitive differentiator. As it relates to automating workflow, productivity is one of the highest priorities for tax and accounting firms. Meanwhile, 84% of turnover is voluntary due to dissatisfaction with working conditions. A firm's ability to automate as much of their workflow as possible is a key priority for firms of all sizes, and QuickFee Connect does exactly that, automating the entire engagement to cash workflow. Janine Hosta from Pease Bell said that not only has their accounts receivable reduced by 90%, but they're now getting their AR related work done in half the time. Finally, QuickFee's ability to pass credit card surcharges onto a firm's client is a huge win for the firm. In fact, Renee Dvorak from Whitley Penn shared that their firm saved about $140,000 last year through QuickFee's credit card solution. QuickFee is well positioned to benefit from the industry trends towards automation and improved cash flow. Our product suite is very competitive in the market, and we're increasingly getting very positive feedback from our customers, so we know we're on the right track. Now I want to pivot and recap on our current strategy and share FY24 progress. Now, we've shared this slide previously, but given it's the foundation of our strategy and key focus areas for FY25, I wanted to revisit it for just a few moments. We think of this flywheel as showcasing the 5 areas that we believe will unlock transformational growth in the US market. And in fact, we're already starting to see these growth areas deliver. Our number one lever on our flywheel is, not surprisingly, QuickFee Finance. QuickFee Finance has revenue yields that are approximately 25 times those of our Pay Now offerings, all while delivering a solution to the market that's unmatched by any other company in the US. It's the reason we came to the US, and it's instrumental in delivering transformational growth. Second, QuickFee Connect is part of our growth strategy. Many firms that have adopted Connect have seen the transaction volume grow by over 40% in the same period over last year. In addition to that, by integrating QuickFee Connect with the most widely used practice management solutions in the US, firms are able to unlock automation capabilities that do not exist in the practice management solution itself. To maximize the transaction volume we capture from our customers, Connect is the key. In addition to QuickFee Finance and Connect, we also need to deliver differentiated technology, build strong partnerships with other leaders in the industry so we can rapidly grow our reach, drive increased awareness, and acquire new customers at scale on a one-to-many basis, and of course, leverage automation across all areas of our business. Now, in FY24, we achieved a number of operational milestones that continue to build on our platform for transformational growth, which included signing 103 new customers, launching 3 new strategic partnerships with Nula, Iris Software, and Allenio Global, and developing and launching our own direct-to-bank ACH platform. I also want to call out the incredible job our product and development teams have done with building out our product functionality. QuickFee Connect has recently launched a new integration with Thomson Reuters Practice CS, while at the same time being very proactive with taking customer feedback and building that into our product roadmap. Our product suite is the best it has ever been, and with our 4 strong Connect integrations, a packed product roadmap that we're delivering on at pace, and our improved functionality in direct response to customer feedback, we're increasingly winning firms from our competitors. And these are just a few of the many achievements in FY24. As you know by now, and I've said multiple times, already on this webcast today, Connect is a key focus area for us, and there are a few callouts worth noting here. First, you'll see that we've introduced a new subscription model to the market and have started with an implementation fee of $19.95 USD and a monthly subscription of $4.99 a month. We'll soon be introducing additional functionality, which will be available at higher level tiers, which of course are at a higher level price point. With that, Connect is incredibly important for three reasons. First, it has a subscription model with monthly recurring revenue streams. Second, it increases transaction volume for all of our solutions. And third, it introduces a very competitive offering that's ideal for firms that want to build their own tech stack, which is becoming increasingly important to firms of all sizes. In FY25, we have a number of new integrations on our roadmap, and we're already working on our next one. QuickFee has a laser focus on implementing initiatives that will deliver the greatest ROI. We have a full dashboard of metrics, including lots of early indicators that show we're on the right track or where we need to adjust. This slide highlights just a handful of these metrics that we track closely and give us confidence that our initiatives are working. You can see here that we've had positive improvements in average annual revenue per new firm sign up, the attach rate of QuickFee Finance for new firms, and the total transaction volume from new firms. That said, we did see a decrease in overall new firm signups, but that's directly linked to our focus on larger, higher quality firms with more opportunity for growth. For example, a potential Connect customer, versus smaller firms with limited opportunity for supporting our revenue and TTV ambitions. These positive metrics can be directly attributed to execution plans that support our strategy, including new commission plans and a redesigned customer onboarding process, as well as improved offerings to attract higher quality firms and new strategic partnerships. Now, in the US, we delivered strong revenue growth with US revenue up 29%, driven by 54% growth in US finance revenue to 4 million Australian and 22% growth in Pay Now revenue to 7.2 million Australian. Our gross margin was impacted by higher interest expense due to rate rises and higher borrowings to fund the loan book growth. However, gross profit was up 21%. The US realized improved EBITDA, now positive at 0.2 million. And finally, new customer acquisition saw strong growth in the number of active firms, which was up 5% to 794, and the active customer numbers, which was up 12% to 357,000. The US also saw increasing transaction volume across all products, with the US loan book growing at 22% in FY24 to 9.9 million US, and finance transaction volume up 28% to 26.7 million. Our Pay Now transaction volume continues to increase, and Connect is certainly playing a role in driving volume, with Connect invoices up 120% in Q4 over Q3. Now let's take a look at how Australia did in FY24. Australia had a very strong FY24 with revenue up 49% on FY23. We saw record lending volumes and also yields, both from the fee funding and legal disbursements funding products. For a mature market, this is a fantastic result and a testament to all the hard work the team has put in over the last year. The disbursement funding product delivers higher revenue per dollar originated than the traditional fee funding product as the interest compounds, and this has contributed to increased revenue yields as the disbursement funding book grows. The book now comprises approximately 1/3 of the Australian loan book at the 30th of June 2024. In December of 2023, QuickFee finalized the agreement with Wingate Corporate Investments for a 10 million Australian dollar funding facility to support this growth. The Australian Buy Now, Pay Later product, QPay plan, which provides finance to the homeowner services market and includes the Gyms Group franchise agreement, had strong growth with FY24 TTV up 100% to 3.4 million on PCP. And FY23 was 1.7 million Australian. This product is making small but growing positive contributions to revenue and EBITDA. With operating expenses down 6% as non-essential costs were removed from the Australian business, the Australian region delivered EBITDA of 2.4 million, up $2.2 million on FY23. Our business in Australia, led by our founder Bruce Coombs, has shown consistent growth over the last 12 quarters since COVID, with Q4 delivering record lending, a culmination of all the hard work the team have put in. Economic conditions continue to work in our favor as interest rates remain high and inflation has not let up. The success of the QuickFee brand in the Australian market is built upon reputation for excellent customer service and ongoing vigorous relationship management activities, which positions the business extremely well to continue its growth. I'm now going to hand it over to QuickFee CFO Simon Yendall to walk through the financials in more detail. Simon, you are on mute.
Thank you, Jennifer. Hello, everyone. We'll run through these financials. Record finance and pay now volumes, as Jennifer mentioned, in both the US and Australia, drove revenue growth of 37%, $20.3 million, $14.8 million in FY23. Interest revenue was up 53% to $11.2 million from $7.3 in FY23. And revenue from pay now, products and other fees was up 21% to $9.1 million from $7.5 in FY23. QuickFee's lending activities are funded 88% by borrowings and 12% from our own funds. The combination of the growth in the loan books and the high interest rate environments, as Jennifer mentioned, in both Australia and the US resulted in interest expense increasing to $4.7 million this year from $2.6 last year. Our borrowing costs are linked to bank borrowing rates in both countries. So the two factors that ultimately drive this cost going forward are the loan book growth and the level of funds drawn and interest rates. The remaining cost of sales increased to $3.0 million from $2.8 in FY23. This line item is made up of variable US ACH and Australian card processing costs and credit and loan approval expenses. The modest increase of $0.2 million in cost of sales reflects the lower ACH processing costs from the move to our direct-to-bank processing model, where now all ACH pay now transactions are processed in-house through two separate banks, and this delivers more internal controls over our processes as well as providing full redundancy, but it also removes a lot of third-party processing costs. So that modest increase is really, it's pleasing to see and reflects the fact that we have managed to remove some of those processing costs from the business. Operating expenses declined by $0.2 million, as Jennifer mentioned again. I'll talk about the cost base shortly. Bad debts remained at the very low levels we've seen historically at 0.14% of lending, which remains a highlight of our business model with that dual credit protection of both the clients and firms, guaranteeing the clients' loans and underpins the credit quality of the firms we deal with. And as Jennifer mentioned, EBITDA improved $3.3 million from $6.5 million to negative 3.2, and impact from negative 8.1 to minus 4.7. And importantly, EBITDA for H2 was close to break even at negative 0.5 million. That's up from negative 2.8 in FY23. And our permanent headcount reduced by 1. We now have 46 staff. There's 26 in the US, 16 in Australia, and 2 non-exec directors. So looking at our cost base in some detail, we've continued to manage costs carefully without impacting the growth potential of our products. We're running a stable cost base of $15.8 million. That's down $0.2 million on FY23. So the chart top right is our total OPEX and the 4 main functional categories along the bottom here. And the reduction in OPEX primarily driven by general and admin costs reducing. We've trimmed some non-essential costs from the business and redeployed our dollars into revenue generating activities wherever possible. And those activities also include investing in our products to take advantage of the revenue opportunities presented by further Connect integrations. Product investment comprises not only rolling out new Connect integrations, but also making our platforms more secure, compliant, user-friendly and scalable, which is all really designed to meet the demands of our firms and their clients. So product development costs in H2 decreased from H1, but while we saw that decrease from H1 to H2, we do expect product development costs to remain at the FY24 level throughout FY25, as we will continue to invest in those opportunities. Over on the balance sheet, our balance sheet has improved over the past 12 months. Reported cash on that top line on the right of 13.5 million. That's up 10.1 million. It's made up of two components: available cash of 6.9 million, and a new component this year, which is 6.6 million of cash in transit. And that cash in transit is from our direct-to-bank ACH processing. So that is cash that is held in our bank accounts on behalf of firms while they process ACH transactions. The clients will pay the firms, but it goes through our bank accounts, and at any one point in time, we'll be holding cash there. At 30 June, there was $6.6 million of cash on behalf of those firms. So the available cash balance of 6.9 million was up 3.5 over June 23. In May and June this year, we successfully finalised a $4.4 million capital raise via a well-supported share placement of $3.75 million and an oversubscribed share purchase plan of almost $700,000. The capital raised will be used to fund further loan book growth in the US and Australia to support the positive momentum in the business. And importantly, our loan book has grown $12 million or 28% to $55.2 million. And this growth has obviously been funded by the increase in the borrowings that we've drawn. Over on the cash flow, this slide has two parts. On the left is a more traditional cash flow statement, and on the right is the reconciliation from loss for the period to operating cash flow. Operating cash flow on the left is comprised of two main elements. First line, net cash outflow from operating activities of negative 4 million represents our operating loss from running the business, and that will become positive once we're profitable. And the second line, outflow from loan book firm funding of negative $5 million represents the cash outflow from funding our loan book growth. That's funded, as I mentioned, by a mixture of debt facilities at about 88% advance rate and our own funds at 12%. And as our loan book continues to grow, the second line will continue to be negative as we lend more money. And that line also contains the working capital movement of the shift to in-house ACH processing. So a bit of a funding update here. We've summarised our credit facilities and growth capacity. As Jennifer mentioned, in December 23, we finalised a $10 million facility with Wingate to support the growth in the legal disbursement funding product. And that provided a $4 million additional equity injection when it closed in December. We're also in the process of investigating supplementary facilities to initially augment and then likely replace in full the Northleaf facility, well in advance of that facility maturing in November 2025. Increase in the utilisation of that facility unavailable from October this year, so we will likely run the Wingate, Northleaf and a supplementary facility until sometime in 2025. But we do not expect any material financial or operational impact from any potential changes in lenders. We expect interest costs to remain broadly in line with where they are currently. So to summarise, as a result of these facilities, the recent capital raise, we're comfortable we have sufficient cash reserves to fund the 10 to 15% equity contribution required that we need to inject for loans to be written as the book grows. And importantly, the business is expected to be operationally cash positive in FY25. So as a rough calculation, the cash available at 30 June to fund lending at, say, 88% advance rate could fund a further 40 million Australian dollars of loan book growth. So we're well placed financially, in addition to being well placed to grow the business. I'll hand back to Jennifer now.
Great, thank you, Simon. So as we look ahead to FY25, we'll continue to have a focus on sustained profitability, supported by acceleration of TTV and revenue from QuickFee Finance and QuickFee Connect. Our Connect integrations will continue to drive increasing demand and opportunity, allowing us to win more new customers and drive pay now and pay over time transaction volume, as well as revenue through our new subscription model. Most importantly, we expect FY25 EBITDA in the range of 1.5 to 2.5 million Australian dollars, weighted to the second half. Our outlook for FY25 is positive, and it's strongly supported by the momentum we've built over the last few years. I have no doubt that we're in the right place at the right time, and that we're well positioned to take advantage of the market opportunity while delivering unparalleled solutions to the accounting market segment. Our top tier management team are leading their areas of the business with a true owner mentality, high accountability, and a sharp focus on outcomes. The same outcomes that you, as an investor, are seeking. We have a proven track record of delivering strong year-over-year revenue growth. Just one of our verticals, accounting, has a serviceable addressable market of $84 billion in the US alone. The market opportunity is tremendous. Given that we have just 14% of our existing firm's revenue flowing through QuickFee, we have the opportunity to 8x our transaction volume without even getting one new customer. Our proposition is different. The combination of our unique finance product, Connect's ability to modernize our firm's tech stack, and our unique pricing sets us apart from anyone else in the market. And finally, we have a customer base of over 1,500 professional service firms, and that continues to grow. We're very appreciative for your time today and hope that you can feel the energy around the results, our strategy, our momentum, and our plans to execute. It's an incredibly exciting time to be at QuickFee, and I believe our best days lie ahead. I'm now going to hand it back over to Katie McKenzie to moderate the Q&A portion of our meeting. Please put any questions that you may have in the Q&A box.
Thank you very much, Jennifer and Simon, for the presentation. Just a reminder, as Jennifer said, to put any questions in the Q&A tab. And just while we are waiting for some questions to come through, Simon, there's a question for you there. There's been a lot of talk in the past week or so about US interest rates potentially going lower by the end of the year. Are you able to talk about what impact that would have on QuickFee in FY25 and what impact, if any, that would have on your earnings guidance that you've released today?
Sure, Katie, that's a good question. As we've mentioned in the past, the rates we charge our clients are relatively inelastic in terms of demand. So we can increase interest rates and it doesn't impact demand. Should interest rates, cash rates decrease, we wouldn't necessarily decrease our rates to customers. Obviously, our cost of borrowings are tied to those cash rates. Currently, we've got about 30 million borrowings denominated in Australian dollars and about 9 million in US dollars. So overall, if interest rates were to rise globally by 1% or drop 1%, that would have an impact of about 500,000 Australian dollars on our interest cost. And that would be split roughly on today's borrowings about 370,000 Australian dollars if the Australian rate changed, and 130,000 if the US rate changed by 1 percentage point. With that regard, that shouldn't impact materially any earnings guidance. But again, I'd stress that we wouldn't expect to reduce the rates we charge clients should interest rates in the economy decrease.
Okay, thanks, Simon. That's very detailed and helpful. A question for Jennifer. You've talked a lot in the presentation about Connect and the importance of Connect to the business moving forward. Could you just talk a little bit about in FY25, what does success look like this time in 12 months? What would we like to see Connect doing? What would that look like?
Sure, thanks, Katie. So I would say, first of all, without providing a direct guidance around what we think we're going to be doing with Connect, I'll give you some ideas of what success looks like. I think, first of all, a firm foundation of happy customers is incredibly important for Connect. With any product that's growing as fast as it is, and our ability to attract new customers is incredibly important, and those references are important. So happy customers kind of underpin everything that we're doing. A solid base of subscription revenue is important. That monthly reoccurring revenue is incredibly important as the business moves forward. Increased finance or QuickFee finance volume as a result of more people getting to our payment pages is important. And then finally, increasing transaction volume across our Pay Now solution. So I think that QuickFee Connect underpins a lot of our other business goals, and seeing it deliver in that way will be important.
Great. Thank you, Jennifer. I'm just having a little trouble clicking on that question. Simon, would you just be able to click on the question that's come through? Are you able to access that one?
Sure. The question is, I think it's probably for me anyway, it talks about, can you shed some light on Q1 FY25 so far? We're seeing, similar growth rates to FY24 really across the board in terms of Australia and the US. So no surprises there in terms of the Q1 rate so far. It's not guidance for Q1, but what we've seen so far is, broadly in line with the past 12 months. We'll continue to invest in the Connect product and take advantage of the opportunities there. So we don't expect to see any decline in sort of the OPEX base in the first half as we try and accelerate some of that deployment into the market of the product. And another question, what's the revenue target? I think, if we continue to grow revenue at the rates we grow in FY24, that will deliver the kind of EBITDA range that we've presented. So, I think that is certainly within our capability of doing. There's a question here for Jennifer. What has the customer feedback after the launch of the integration with Nula been like?
Yes, so the feedback coming out of our Nula integration has been extremely positive. We did a lot of due diligence on Nula prior to getting into a partnership with them and had customers take a look at the product. It's incredibly robust as far as functionality, and it's very easily customizable. We have customers that are using Nula and QuickFee together today, so that integration is in practice. Some of my favorite things are when we have a client that is looking at a competitive solution, and when we talk to them about why they're looking elsewhere other than QuickFee, they said, well, I just want to be able to have something that does engagement letters as well. And so when they find out that we have an engagement letter solution integrated, it's incredibly valuable because we're able to save that customer, and we see that almost every day. We see something like that. So it's been a very good partnership, and we have some really happy customers as a result.
Right, thank you, Jennifer. And we got another question here on any customer feedback. It is only early days with Thomson Reuters, but if you have had any customer feedback following the launch of the integration with Thomson Reuters.
Yes, and I would invite all of you to come, and if you come and sit in the office here, the feedback is electrifying. I would say everyone in the office is buzzing with it. The week that we launched, or just the week after we launched, we had our entire sales team and our relationship managers all in the office together. Some of those folks are field-based, but they were all in the office, and it was all hands on deck. We have one of our sales reps mentioned that tomorrow he does not have any break in between meetings all day. It's just TR, practice CS, Connect demos all day long. So the response has been incredibly good. The Thomson Reuters customers have been waiting for this. And I would say, when you look at the overall revenue impact, I think that we're starting to build a subscription base, so it takes some time, but we're already seeing that implementation revenue and that subscription base grow. So we've been very pleased. We had a webcast last week and had 100 people on it just to look at TR integration, and I was pretty impressed with that. So we're excited.
Sounds great. We've got a specific question here on the next Connect integration. Now, we didn't talk to that specifically in the presentation. We sort of talked about it in terms of an overall roadmap. Jennifer, I'm not sure if you're able to add any more color to that.
Oh, sure. I wasn't going to, but what the heck? Why not, right? So, the next Connect integration that we're working on is with a practice management solution called Practice ERP. Practice ERP is built on the NetSuite platform. And actually, I just met with one of our customers earlier today, and she said, oh, I'm sorry to tell you that I'm changing practice management solutions. And I was like, okay, what solution are you going to? And she said, practice ERP. I'm like, well, that is just great news because we have that integration that will be done within the next couple of months. So they have a really nice base. We offer some competitive differentiators against that put us in higher regard than some of NetSuite's existing payment integrations, and we're well suited for the accounting space. Additionally, one of our largest customers is moving over to Practice ERP. So we have some good momentum and referrals already coming in for that integration, and we're not even done yet.
That's great news. We have a question here. This one could be one for Simon or perhaps Dale, if you wanted to chime in as well, just to share your thoughts on the economic environment in Australia. You sort of seen the outlook for FY25.
Yes, I think there's been a huge spike in the past probably 6 to 9 months in terms of insolvencies. There's a lot of the businesses that survived during the pandemic that may not have been capable of surviving under ordinary conditions failed. That hasn't really impacted us too much because accounting firms and law firms tend to survive in both good and bad times. I think cost of living pressures are still there, but there's still small businesses are still growing, they're still spending on legal and accounting advice. But I think it is still pretty tight out there. There are a lot of small businesses who are struggling. As we've seen, we've managed to grow all parts of our Australian business. So those conditions continue to work in our favour.
Thank you. Jennifer, in the presentation, you talked about M&A activity being high in the US, particularly in the accounting profession. What are you seeing on the ground, and how do you expect that will impact QuickFee over the next 12 months?
Sure, there is definitely impact to our business, and sometimes it works in our favor, and sometimes it does not work in our favor as much. I think, we visited with a firm today that was, they're not a huge significant firm. They don't have a lot of noise in the market. They're not making a lot of noise in the market as it relates to acquisitions, but they've recently acquired one firm and they're going to be acquiring more. So it's just, that is happening across the board. And it is a huge area of the accounting space right now. Accounting Today just launched their first private equity conference just focused on the accounting profession. That's how big it is. It's a conference just focused on PE. So I think that some of the impacts that we see on QuickFee when we're on the right side. So we're working with a large firm that is in acquisition mode that's acquiring probably about a customer or a firm a month, or sometimes 2 in 1 month. That works very well in our favor because when they make an acquisition, they move them over to the QuickFee platform. So that makes it very, very nice for us. On the reverse, we could be working with a firm that is, we have great relationships. They love our solution. If they're acquired by a firm that doesn't use QuickFee, sometimes we lose that business, even though we've had a great relationship, even though we're really tight with the firm, because that they didn't know they were being acquired. That came as a little bit of a surprise. So I think our strategy of making sure that we're in with the firms that are in acquisition mode to make sure that we get as much of that business as possible is a smart one, and we'll continue to do that.
Thanks, Jennifer. And then a follow-up question on the M&A. This could be one for Dale. If you have seen any offers? Is the specific question? Have you seen any offers to be acquired by a larger organisation? And then I guess a broader question, about your M&A strategy.
I'll give a very chairman-like answer to the question. Clearly, as a board, we are looking to maximise value for all shareholders. So we're, as per Jennifer's presentation and Simon's excellent financial report, we are laser focused on reaching and achieving sustained profitability. In our view, that is the best way to add value for all shareholders. At that point in time, I don't doubt there will be a raft of M&A style opportunities, partnership opportunities that will open up for the business. And of course, we'll look at each one of those as they come towards us. Right now, as I said, we're focused on running the business, doing more of what we've been doing, achieving our budget for this year, and then we can address, those other intangible opportunities as they come along.
Thank you, Dale. Yep. We've got a question here. This could be one for Jennifer on the white label payment interface and secondary business verticals other than accounting. Are you able to touch on those, Jennifer?
You bet. So on the white label payment side, we're actually working with a company right now that has a large professional services customer base, and they have their own payment division. So they have their own Pay Now or ACH and card division. They don't need those services. But what they don't have is our finance product. Our original discussion started around white labeling and evolved because they said, you know what, there really isn't value in us in white labeling because we're not a commercial lender. We don't have the track record that QuickFee has with lending. You guys understand the market. You have credibility in the accounting space. We're actually better off to keep it labeled as QuickFee, and we're just offering it in partnership with QuickFee. So we are looking to go out to their customer base shortly after. There's a September 15th tax deadline, and we have a go-to-market plan that will be starting with them immediately following that. As it relates to secondary business verticals, we just had a meeting on that earlier today. Our Chief Growth Officer, Chris Smith, has 3 different verticals that he is building out go-to-market plans over the next few months. So we are fully ready that come January, as we head into tax season, we are going full court press after other verticals. So we maximize the opportunities while the accountants are heads down in tax season.
Great. Thank you, Jennifer. We have a question here on the investor relations side. So a comment that the number of investors in QuickFee has decreased over the past year, and what are we doing what's QuickFee doing to improve the visibility of QuickFee in the investor community? So I'll have a first go at answering that, and then I'll hand over to Simon and Dale if they would like to add anything further. So we have been very committed to doing lots of webinars after the quarterly and after the half year and full year results and the Investor Day. So we are constantly presenting the results back to the market and always open for questions. We are about to launch an investor hub, which we think will improve transparency to investors. There'll be opportunities there for investors to ask questions and for us to make those questions available to all shareholders, and we'll be posting more information, not only ASX releases, but some more PR and soft news flow as well onto the investor portal. So we are absolutely committed to transparency and engaging with our investors, and we do have some strategies in place to improve that. But I'll hand that over to Simon and Dale if they've got any other comments.
Yeah, thanks, Katie. Oh, sorry, Dale.
No, sorry. Go ahead, Simon. Go on.
I was going to say, I mean, we're all cognizant, we'd like to be further advanced on our path to profitability than we are. And I'm sure, all our shareholders would like us to be as well. We have welcomed new institutions onto the register as part of the share placement this year. But we are, very, very cognizant that, smaller retail shareholders are the ones who can influence the share price in the sort of short to medium term as much, and they're the ones who are currently buying and selling. And we, as Katie mentioned, are very, very focused on how we can engage, support, and communicate the message to the non-institutional shareholders as much as we can. And we will be ramping up that kind of presence in the marketplace to try and give as much information as we can to the investing community.
Thanks, Simon. I was just going to say the same thing in relation to welcoming some substantial new institutional shareholders to the register, which I think is a testament to the progress the business is having. So yeah, I just echo what you said there, Simon.
Okay, thanks, Dale. We have a comment here, I guess more looking at posting monthly updates. I haven't spoken to Simon and Dale and Jennifer about that. My view is it's not our intention to move to monthly reporting. I think quarterly reporting is provides ample opportunity to communicate the results. Simon, did you want to jump in on that?
Yes, we have had that question a number of times. I'm aware that it is of interest to some people that we would post sort of monthly volume numbers. The challenge we have is that our business is very seasonal, and even within one quarter, you can have a soft month that's then compensated by a stronger month. Good example is in March and April, depending when Easter and the school holidays fall. You can actually have a stronger March and a weaker April, or vice versa. So if you're publishing numbers and they actually decrease from one month to the next, and can happen from, say, December to January, unless you're very, very clear, you run the risk that people will take that as growth slowing. These any sort of fluctuations tend to even themselves out over the course of a quarter, and we've traditionally reported quarters and will probably continue to do so for those very reasons. It can probably, you go too granular, and you lose the message, and you can't see the trend as much as you think you might.
I think one thing that I would just add on to that is that, we just they shared a moment ago just around the Investor Hub. I think that when someone is asking about, can we look at more regular updates? I think that you'll get that with Investor Hub. It might not be the exact one pager that contains all of the exact information, but I think that regular flow of information will be easier for us to get to our investor base. It'll be easier for you to ask questions, and I think there'll just be a constant flow of information. So I think it will feel much more like a continuous conversation versus quarterly updates once we get that Investor Hub live.
Yeah, I agree with that, Jennifer. Yeah, that's right. Then we have got a final question here. So just a reminder to everybody on the call, if you've got any questions, type them into the Q&A tab. But the final question here that we've got at the moment around the Australian BNPL, given it's relatively small, is the question, has there been any thought to shut this down and improve the focus on core product lines in Australia? So I think, Simon, that's probably one for you on Australian BNPL.
Yes, it probably sounds a bit trite, but we continually monitor all aspects of our business and all products to make sure they're performing and generating the returns we expect from them. The business, BNPL business, literally takes one staff member. He's not a distraction for Bruce, myself, or any other management team, and is generating a small amount of cash from quite a healthy and growing base of merchants. So at this stage, we have no intention to, but we'll continue to monitor it.
Okay, thank you. Thank you, Simon. I can't see any other questions there, but just a reminder that if you do have other questions, feel free to email Simon or myself later. And as I said, we'll have the Investor Hub up and running, in the next month or two, just to, you can be easy to ask questions there. Jennifer, I'll hand it back to you just to wrap up the presentation.
Great, thanks, Katie. As I shared earlier, I just want to thank you all for joining us today for this update. We are honored to have you as part of our investor base. We are extremely energized about what's happening in the business. It's some days it's just a crazy ride hanging on to keep up, and it feels really good. It's hard to sometimes articulate that through a presentation and slides and a lot of number updates, but I can assure you that there is a lot of excitement in the business and a lot of momentum, and every single functional area feels it. And I hope some of that came through today. But we look forward to engaging with you and increasing our engagement with you through the Investor Hub. And we just want to thank you so much for your support of our business and our team. And we look forward to many more successful updates ahead. Thank you for joining us today.
Right. Thank you.
Thank you.
Thanks, everyone.